Hey, welcome back to Everyday Economics. This is the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our podcasts at americastalking.com. To support Everyday Economics and podcasts such as this one, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Thursday, July 13th. And joining me, as always, my friend and colleague, Dr. Orphe Divounguy, PhD economist. And we have two significant pieces of the puzzle to discuss. Consumer price index information came out on Tuesday. We're taping this on Thursday. And producer price index numbers came out today. So first of all, let's share the data. CPI numbers were interesting and I think potentially positive. The PPI number came out today, and that number is it's scant. So let's talk about, first of all, what are the numbers and what do they mean?
Oh, for sure. So first thing is this is news, right? The CPI was out yesterday. Inflation cooled further in June. You had consumer price index increased 0.2% over the month of June, 3% higher than prices were a year ago. So you have a 3% increase year over year. That's the lowest since 2021, since March 2021. Unbelievable, especially where we come from, right? We came from over 9% inflation in June or July of last year, a year ago. Core CPI, because I think that's the real important thing here, at least for the Fed, is up 0.2% in June, also cooled down, now down to 4.8% from a year ago, compared to 5.3% in May.
Right. Let's talk about these numbers in isolation. So CPI is really where, the everyday person feels it. That's a measure largely of the goods and services, the consumer basket, where people really live. I mean, they see that at the grocery store, they'll see it at, the department store or see it online where they shop. Only 3% or only 2%. That's in addition. When we have these conversations, I think we need to try to simplify this as best as we possibly can, because people are like, well, whoa, hold on. Prices I'm paying for things are still really high compared with what I'd formerly had paid for it a year or more ago. So you've paid the 9%, and then CPI came in at 2%.
3% year over year. So basically consumer prices are 3% higher than they were in July of 2022.
Not to oversimplify the math and say 12% from where it would have been in 2021, because it would be slightly more than that. But if you're thinking about things in the context of what you might have paid for something in 2021, when stimulus money was still flowing into the system, and you look at what you're paying for it now, there's a big difference there. 12 to 15% more.
For sure. Absolutely. And so it's important to explain this to people, right? So like prices are higher for sure. And prices in a well-functioning, growing economy grow at a low rate. And that's why the Fed is targeting 2%. Prices grow in a
typically 2% is what you can expect.
That's right. But to be very clear, right? People have gotten an increase, on average, an increase in their purchasing power, right? When inflation comes down faster than the decline in wage growth, because wage growth, median wage growth is still roughly 4.4%. And so when you have wage growth at around 4.4%, but CPI price growth at around 3%, you have an increase in your purchasing power, or what we call wages adjusted for inflation, or real wages. And so the name of the game here is to see inflation come down, right? And as inflation comes down, people get an increase in their real purchasing power. Their wages adjusted for inflation. And what we want to see is incomes kind of catch up, right? Incomes catch up. And this is why the Fed decided to put its foot on the economic brakes. It's because it was unsustainable, right? If prices are rising much faster than incomes, then people are squeezed and they can't keep up. But it's not just households, it's also businesses. Businesses are trying to keep up, right? And then they can try to pass on those costs to consumer, and we go on and on like this, and then eventually the whole thing breaks down, right? It's not sustainable. And so you've seen countries where you have hyperinflation, people are starving, right? It's not sustainable. So yes, prices are higher than they were at the start of the pandemic, but price growth has slowed, allowing incomes to catch up. And so now we have an increase in real wages. And in fact, the Goldman Sachs has what they call a current activity indicator, which is basically another measure of real-time economic output, better than GDP because we get GDP on a quarterly basis. And at least this indicator, we can get it on a monthly basis. And then what it shows is that current activity has gone up in June. It is basically above trend. What it shows is that this is driven by a smaller contraction in manufacturing and an uptake in consumer and housing, right? And so, you have this upward push. And now the fear for some people is that as wages adjusted for inflation continue to increase, then you could potentially have the consumer going out and spend again. And then you'd have that upward pressure on prices again, especially on the services, on the discretionary side, which would be a big, big problem for the Fed, right? And so, yes, the inflation continues to cool. Disinflation is very much underway. We had a positive consumer price index release yesterday. We have positive news on the PPI front with prices falling as well. PPI measures basically the prices that the average change over time for selling prices received by domestic producers for their output. And so you look at a producer price index, you look at a consumer price index, both are going in the right direction. Prices are coming down. Now, again, I mentioned two things. You have one, the possibility that with an increase in purchasing power, you end up seeing people going out and spending again. I think if that happens, the Fed's definitely going to start raising rates again. On the other hand, there's this broader cooling. The labor market remains strong, which is good news. It means potentially we have a soft landing. Recession risk is receding. So you have inflation cooling, recession risk receding. Potentially we land this plane safely. And so that's where we are. I think a lot of people are starting to think maybe the Fed's not going to raise rates again because inflation's cooling so rapidly. We'll see.
Well, I appreciate your thoughts as always. For Dr. Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics at americastalking.com.